Welcome back to the channel. Today we are working through extension ledgers in SAP S/4 HANA, and specifically the use cases SAP actually builds on top of them. This is a favorite area for the financial accounting certification, because it sits right where configuration knowledge meets real business scenarios. By the end of this video you will know what an extension ledger is, how it differs from a non-leading ledger, the 3 extension ledger types and what each one is for, and the limitations that examiners love to test. Stay to the end, because the last question catches almost everybody who has only read the definition and not the restrictions. Here is how the next 10 minutes are laid out, and the order matters. We start with the architecture, because if you understand that an extension ledger stores only delta postings, you can reason your way through most questions without memorizing anything. Then we compare it directly against the non-leading ledger, since that comparison is where the exam gets its distractors. After that we walk the 3 ledger types and the business use cases SAP has actually delivered for each one. We finish with limitations and 2 full exam questions, worked end to end. Start with the mental picture, because everything else follows from it. An extension ledger is not a full set of books. It is a thin layer of adjustments that sits on top of a standard ledger, and the system adds the 2 together when you run a report. If your leading ledger is 0L and your extension ledger is ZX, posting a document to ZX updates the balance of ZX only. The leading ledger is untouched. That single design decision is what gives extension ledgers their main selling point, which is a very small data footprint compared with running another full parallel ledger. This table is the single highest yield thing in the video, so screenshot it. Notice the pattern in the middle rows. Posting periods can differ, because that is a timing control and costs nothing architecturally. Fiscal year variant and currencies cannot differ, because the extension ledger is reading the underlying ledger's data and the 2 sets have to line up to be added together. If you remember the reason rather than the rule, you can answer variants of this question you have never seen. One more point that examiners like. The underlying ledger for an extension ledger can never be another extension ledger. When you define an extension ledger you must specify 2 things: the underlying ledger, and the extension ledger type. The type is not cosmetic. It determines whether the journal entries get real document numbers or only technical numbers, and whether those entries can be deleted. Standard type behaves like ordinary accounting and is what you use for manual adjustments. Type P is for entries the system generates that must leave an audit trail, so they can only be reversed. Type S is for entries the system is expected to throw away, which is exactly what simulation needs. Match the type to whether the data is provisional or permanent and you will get these questions right. This is the classic use case and the one most consultants meet first. The business wants a management view of the numbers that differs from the statutory view, and they do not want to restate the legal books to get it. You give them an extension ledger, they post their top side adjustments there, and management reports pick up base plus adjustment while the statutory reports stay clean. That last bullet is worth dwelling on. Because an extension ledger can carry its own posting period variant, the adjustment ledger can remain open after the underlying ledger has been closed, which is what makes late management adjustments practical. Predictive accounting is the flagship use case and the one that turns up most often in questions about margin analysis. Think about order to cash. A sales quotation and a sales order are not accounting relevant, so in classic ERP nothing hits finance until goods issue. Predictive accounting changes that. The moment the sales order is created, the system simulates the follow-on documents and writes predictive journal entries into a P-type extension ledger, complete with document splitting and cost of goods sold derivation. Commitments work the same way for the purchasing side. Both need an audit trail, which is exactly why they use Type P rather than Type S. Simulation is where the Type S deletion behavior earns its keep. Take foreign currency valuation at period end. Normally you find out the impact of exchange rate movements when you post the valuation. With a simulation ledger you run the valuation in simulation mode as often as you like during the period. Look at a full financial statement that combines the simulated valuation with your real postings, and make decisions before committing anything. When you finally run the valuation productively, the system deletes the simulated documents automatically. Nothing has to be reversed and no cleanup job is needed, because deletion is built into the ledger type. Here is the framing that makes these questions easy. Extension ledgers were designed to add reporting layers, not to run business processes. Anything that needs an integrated document flow, a customer open item, a vendor reconciliation account, an asset with parallel valuation, needs a real standard ledger. So when a question describes a customer who wants full parallel accounting under a second accounting standard, including asset depreciation, the answer is a non-leading ledger, not an extension ledger. When a question describes adjustments, simulation, prediction, or a management view, the answer is an extension ledger. Pause the video here and pick your 3. Read every option against the Delta architecture we covered rather than against your memory of a slide. 2 of these options describe settings, and the whole trick is knowing which setting can vary and which one is inherited. Take 20 seconds, then we will work through all 5 together. The correct answers are A, C and D. Option B is the trap, and it catches a lot of people, because non-leading ledgers really can have their own fiscal year variant and the 2 ledger types blur together in memory. Extension ledgers cannot, because the system has to add extension ledger data to underlying ledger data at reporting time, and that only works if the periods line up the same way. Option E fails for a related reason. Chaining extension ledgers would mean stacking deltas on deltas, so SAP requires the underlying ledger to be a standard ledger. This is the one I said would catch people. Pause the video and pick your 2 answers. The words that matter in this scenario are repeatedly, before posting for real, and impact on the financial statements. Each of those phrases points at a specific behavior we covered earlier. Take 20 seconds and then we will go through all 5 options. The correct answers are A and C. Option B inverts the 2 technical types, and it is the most common wrong answer because both types sound similar when you have only read the list once. Option D is a nice reminder that neither technical type produces real document numbers, which is precisely why they do not disturb your document number ranges. Option E is a distractor built out of standard ledger knowledge, since a new standard ledger really does raise migration questions. Extension ledgers never do, and that no migration property is one of their main selling points. If you take 3 things away from this video, take these. First, delta not duplicate. This one sentence answers most architecture questions on its own. Second, the ledger type follows the fate of the data, so ask yourself whether the entries are meant to be thrown away, kept as an audit trail, or treated as real accounting. Third, an extension ledger is a reporting layer and not a set of books, which is how you tell an extension ledger scenario apart from a non-leading ledger scenario in a wordy question. The natural next topic is the other side of this comparison. So the next video walks through non-leading ledgers and how parallel accounting is configured end-to-end. If you have system access, go into transaction FINSC_ledger and define an extension ledger against 0L. Seeing the type drop-down for yourself makes all of this stick far better than any slide can. If this helped, subscribe so the rest of the financial accounting series reaches you. And leave your exam code in the comments so I know which topic areas to prioritize next.